Good morning. Happy Friday. Brett here with Directors with this week's market recap. So, as always, wanting to start off with the closing prices of the 10-year note. So, Monday closed at 3.922. Tuesday closed at 3.916. Wednesday closed at 3.994. Thursday saw a jump up to 4.073. And so far today, the current price is 3.983. So nice to see a little bit of consolidation and pullback today, especially when we're teetering over that 4.0 position. So I wanted to do a little recap over the last 4 or 5 months here of what we've seen. So the 10-year note peaked at 4.3 in mid-October, then saw some ups and downs. And there's been an interesting trend kind of for the 30-day segments. So for example, as of November 8th, we had a 10-year note price of 4.15. And then over the next 30 days, it drove down to 3.4. It's a massive drive down by December 6th. Then it kind of turned around and went back up to 3.87, so almost 3.9 by December 29th. So again, 23 days there. Then from December 29th, drove back down to 3.3. Again, very close to the 3.4 figure by 2.1. So again, another 1 month period. Now, since 2.1, it's driven back up to yesterday of 4.07. So you can see we've been kind of teetering here on a month-to-month basis of the lows 3.4, maybe 3.39, on the highs 4, 4.07, 4.1. So that's definitely a wide range. And I think what we're seeing at this point is the market's really just trying to digest what's going on. We have a few economic reports one way, a few the other way. The Feds may come out and have some comments in one direction as, hey, good news, inflation's subsiding. Hey, the next week, it's the opposite. So I do think we're going to see overall trends again of stuff coming down, but I think it's going to unfortunately be relatively volatile as there's just so much for markets to anticipate and they're so reactive at this point for us. So I think the focus for everyone at this point would be is what's the long-term play? Very, very hard to know the short-term movements over the next month or two. Obviously, we hope to see things improve, but we know long-term. Two major pieces for us. As inflation does come down the next year, 2 years, it will drive rates down. Secondly, Fed quantitative easing. I think I've mentioned this in a couple of videos, but the Fed has 2.6 trillion in mortgage-backed securities on their balance sheet, and they are dumping 97 billion a month over the next 12 months. So that's a huge amount. It's oversupplying the mortgage-backed securities market, artificially making pricing worse in rates. So again, once they stop that in 12 months or greatly reduce it and inflation comes down, that will help us. So it's great to remind our clients, guys, from a long-term perspective, home values will continue to go up. From a long-term perspective, rates will go down. Those are two great things that are going to only improve everyone's position and still make it make sense to buy. So as always, any questions, feedback, scenarios, please feel free to reach out. And I hope everyone has a great Friday and awesome weekend here. Thanks. Bye.